February 25th, and here's your weekly market update. First off, just apologize if I sound a little funny. I've got a little bit of a cold, so if I sound a little bit like Elmer Fudd this morning, you'll know why. Anyways, like I said, February 25th, so that means spring's coming here pretty quick, which also means we're heading into the busiest real estate buying season. As a result, I thought I'd take the time today to talk about a little bit of a shift in the market that I'm seeing, and hopefully some valuable information for you to have for yourself and maybe to pass on to your clients. What we're seeing is now that we're starting to see a lot more real estate transactions, a lot of banks and lenders out there are really jockeying for market share. And what I'm finding is over the last year or two, there's become a real push or a real sensitivity in the market with regards to interest rate. Mainly, I would say it's due to the internet has become such a useful tool for buyers and for clients out there. It's so easy to get market information now with regards to interest rate that banks are really competing hard on it. As you know, there's a lot of rate comparison sites out there, and a lot of pure internet lenders and internet brokers out there that compete on nothing but rate. So what I'm seeing is, as a result, in order to capture this market share, there's a little bit of a resurgence of an old product out there. It used to be referred to as no frills products, and they're starting to come back again, which, in a nutshell, it just means that banks are offering products that are stripped down a little bit from their regular mortgage products. They strip away things like your ability to prepay the mortgage. In some cases, it limits the length of the amortization that they'll allow, which is shorter than the maximum allowable. Other things that we're starting to see in the market, and things that your clients might want to watch out for a little bit more, is we're seeing what's called a bona fide sale clause sneak into a lot of mortgage contracts, which essentially means that once you sign on to that contract, if you want to do any kind of a change or any kind of a refinance on that mortgage prior to your term coming up, or even at the end of your term, you need to actually have a bona fide sale or an actual sale on the property. Otherwise, you have to do something with your incumbent lender, which kind of puts you in a bad position from a competitive standpoint, because that bank knows that you can't do anything but do something with them. So it's hard to imagine they can be very competitive on that. The other buzzword that you'll probably hear around lately, in the news and online, is a lot of banks are moving to collateralize their mortgages, which is a different way to register the mortgage, where the mortgage is actually wrapped in a collateral charge, and can be combined with your credit cards and other consumer credit that you have held at the bank. And there's definitely some advantages and some pretty distinct disadvantages to having your mortgage registered that way. And it's important that clients know what they're getting into when they sign on for that. And I'm going to touch on that in a lot more detail in weeks to come, because I think that's probably a section in its own. The other biggest concern, I would say, with this real drive for interest rate and rate only shopping is we're seeing a lot of bait and switch in the market. It used to be something that there was a lot of internet brokerages and that would utilize this this tactic, but there's really not very well written rules around what you can post for with regards to rates. It's really hard to monitor whether or not someone's advertising a rate that is still valid, or if it's something that they haven't updated their rates for 2 weeks, and maybe rates have gone up but they still have the old rates sitting online. It's really hard to monitor that and to police it. So a lot of times people are getting roped in with a low rate offer, only to have it switched out once they've gotten into a meeting and are actually discussing the products. And I mean, the idea behind that is for a lot of people, they don't have a whole lot of time to be doing multiple mortgage applications or shopping physically. So once they're in there and they've got their application down, and the broker or the bank switches the product from what they're expecting, by a lot of times by default the client is just throwing their hands up in the air and staying there anyways. Last year there was a real big push this time of year. If you remember, Bank of Montreal was really aggressive at the time. They had a 2.99% 5-year rate, which was really good in the market for rate wise, but it had a lot of restrictions on it. and as a result, we're seeing that after that big push last year, I think well over half the people that came in for that 2.99% 5-year were leaving with a completely different product. And you know, it may not have been blatant bait and switch, but they're definitely bringing people in the doors with that offer, and then trying to steer them towards something else. So just another thing to be aware of. You know, everyone seems to be offering great rates these days, and I just think it's more important that people realize and you know, are educated what they're getting into, and know that there's a lot more that goes that should be going into planning your mortgage than just simply the interest rate. So just a few things for you and your clients to be aware out there. You know, from a regular or from a interest rate standpoint, and an update for this week, there's not too much to really update on. As I mentioned last week, there was a couple drops in the major products that we see out there. You're still looking at a 2.89 for a fully featured 5-year fixed rate right now, and that 3.69 on a 10-year is just is really taking off. There's a lot of people taking advantage of that you know, are really conservative or have a bleak outlook for where interest rates might be going in the next 5 to 10 years. The only product that I saw a little bit of a dip on this year or this week was actually the variable rate mortgage. This has been completely, you know, a product that hasn't been utilized by myself anyway. I've sold probably just a handful of variable rate mortgages in the last year and a half, simply because it's just too close to what the fixed rate offer is, and it's hard to justify taking on that risk of you know, variable interest rate and payments, knowing that you can lock in for pretty much the same amount. But we saw a little bit of a dip this week. It's down to prime minus 0.40%, which tells me that there are some lenders out there that are just saying, you know what, it's getting too expensive. The margins are too thin to keep on trying to grasp market share, you know, in fixed rates. So maybe if we start dropping that variable rate discount again, or sorry, increasing the discount, we can start getting clients to maybe move toward that product, and I think they're actually probably going to make a little bit more money off it. So hopefully in the next few weeks we might see that approach prime minus a half again, at which point it does become a viable option for a lot of people. So it's going to be something interesting to watch. So that's it for this week, guys. I hope you guys have a great week out there, and feel free to call me or email me anytime, and